All right, I'm gonna call this Finance Committee to order. It looks like we have all three members, including me, Finance Committee here. We just spoke about this, and I already forgot who's on the committee. It looks like it's Sarah Keppel and Tom Bullock and me, Jason Schachner, for you who don't know. We'll start off with, I'll move to approve the minutes of December 19th, 2022.
Second?
All right, motion and second. Any discussion? All those in favor?
Aye.
All right, ayes have it. Now, we're here today on several, I'll count them. 1, 2, 3, 4, 5, 6. 6 ordinances concerning the issuance of notes, essentially to pay for a bunch of stuff that are listed in the ordinance. The agenda's there. We'll talk about it later. But I understand that we have Key Bank here. Hello. We have Bricker and Eckler here. Hello. Nice to see you in person. Yes, making the trip. And of course, our finance director and associates, and Mr. Vargo and Sean and Dave. I'm just testing if I remember everybody's name. So I think we could get started by having our esteemed member from Key Bank to explain all this to us. See, he has a nice handy presentation all printed out. And go ahead.
Thanks. Great. Well, thank you and good evening. My name's Jeff Rink. I am a managing director at KeyBank Capital Markets and have had the joy and the pleasure to work with the city for a number of years in my capacity at KeyBank as I guess I would describe the bank's investment banker in terms of when the city needs to borrow money for their capital, for your capital plan. I'll just quickly mention, just because I don't know that I've had the pleasure to get to know everybody on council most recently, given that we haven't been able to be in person, so great to see everyone in person. But I also had the pleasure, this is going back a few years, where I actually worked for the city of Lakewood before I went to KeyBank. So that's amazingly enough, probably now 18 years ago. But have always loved the city. I actually worked over in Sean's department. So it was great then, and still is wonderful to be a part of the city and to watch how everything continues to move forward. So thank you for the opportunity. I am joined today by Catherine Swartz. Catherine is the city's bond counsel, so does all the legal work on the city's borrowings, as was mentioned from Bricker and Eckler. So we'll tag team this, and she'll certainly comment on some of the legal items. And then if there's any questions at all, please feel free to stop us, and we can certainly answer questions as we go along as well as at the end. So again, thank you, and wonderful to see everybody. So what you have before you is the city's annual borrowing. Typically, the city will borrow in a short-term fashion, and that's what we refer to as notes, as opposed to bonds, on an annual basis to fund a lot of your capital. Unlike many cities, and this is a tremendous positive, and it's recognized by Moody's, which is one of the main credit rating agencies that we'll talk about shortly. Unlike many cities, the city of Lakewood has, and it's very important, has dedicated revenue sources to pay for your capital projects. So while we talk about in aggregate a large number today, I think the number as we get into the presentation is going to be in the upper 30s as far as borrowing. That is a big number. But unlike many, many communities, Lakewood has long ago put into place either statutory charter millage that has to be used for these types of projects. So it's not like you're faced with a policy decision in terms of you're giving up something else to fund these, and or enterprise revenue type funds like water and sewer type improvements, right? So The city has been, I think, very wise in years ago setting all of that up. Many communities we work with have to fund these types of projects on an annual basis right out of their general fund. And so they really have tough decisions. Not that this, I think you look at decisions more about what are the projects and what's the capacity, right, to be able to fund. A lot of cities also have to make decisions even beyond that around do they need to roll back other programs to have general fund dollars to fund capital. So again, a large number, but understandable given that you have identified revenue sources. So we put together some material here. I think there may be some handouts up top, and the wonderful clerk may have sent them out in advance of the meeting, but obviously it's on the screen as well. The first 2 pages, we always just like to lay out all of the city's debt issues. So if someone were to ask or want to know what's all of the debt that the city currently has outstanding, it can actually be found on pages 5 and 6. It's starting with going back to 2012, which, as you can see, will be paid off at the end of this year. The last payment will be made this December. And then all the way through up, if you go to the next page, the city's current note issue, which is coming due in March, that would be taken out or basically refinanced with this new note issue. That would be issued for purposes of retiring the current note and then adding more projects to that. The city has traditionally been on, and this could change if the city sort of wanted to. This is the city's decision, but there's always a cost to do notes, and then there's a cost to do bonds, right? As I said earlier, notes are typically 12 months or shorter. So we're seeing a lot of notes that would be 9 or 12 months in that range to borrow. And a lot of municipalities, Lakewood included, will borrow shorter term type notes while the projects are being constructed. And then as the projects are completed and the final costs are all known, it's typical to take those projects and the amount that's funded in the note for those projects, and in the year that those notes come due, flip those to longer term bonds, because you have a fixed cost now on those projects and you can lock in interest rates so that you have a mix of short and long-term debt. That has typically, I think, Catherine and Peter, Keith, I think that's typically been about every 3 to 4 years that the city will do a bond issue and take out a good portion of their notes.
It's a good average.
Yeah, probably a good average, right? Sometimes
shorter, sometimes longer.
Right. And part of what drives that is not just the projects being completed, but also what refinancing opportunities you may have of your previous debt, right? So although you do have older debt, after about 10 years in the municipal space for city government, the typical period is after 10 years of debt being outstanding, you are allowed to refinance it without any type of penalty. And so we're constantly monitoring that. And what sometimes will drive whether you do a note or a bond will be whether there's any refinancing opportunities. And so Catherine was just saying before the meeting, I think it was 2 years ago, we actually did a bond issue in which we refinanced everything that the city could, which resulted in savings. Just if you think of it as if you refinance your mortgage on your house, you're doing it for no other reason, frankly, than savings. And so we fortunately, I think, hit the market at the right time a few years ago, given where interest rates were at the time. So it's possible that, depending on how the market looks, we may talk next year about a potential bond issue and a note issue. It may just be notes. And then if it was, probably 2025 would be, I think, probably the latest before you would want to flip some of this to bonds. Long-winded sort of intro here to basically say, though, we're just before you with, I know, a number of ordinances or resolutions, because there's different projects is the only reason. They'll all be sold as one note issue. It'll be 12 months. And then at this time next year, we'd be back here to talk to you about what we're suggesting be done with that debt. To get into the specifics of this year's debt, starting on page 8, The amount that's going to be financed and sold is $37,695,000. That could change slightly, but should pretty much remain the same. The security for this debt, so if you buy, I say you, if a bondholder or a purchaser, an investor in this debt, and most folks that will purchase this type of debt are going to be bond funds, insurance companies. Individuals won't necessarily purchase this, but individuals that would invest through a financial advisor many times will end up with this type of debt in their portfolio. And then a lot of times other governments, other cities will purchase this type of debt as well. The security, though, is a general obligation of the city. So it's really backed by your ability to levy property taxes. Some of the past debt, you may recall, for those that have been on council for a number of years, we've secured it with income taxes, income tax revenue. That was primarily driven by, there's some statutory debt limitations, which, while they apply to all Ohio municipalities, every municipality is different. As I said earlier, you have revenue sources to pay your debt, so it's not quite as important to fall within those debt limitations. Those are more drivers where cities are actually paying all of their debt out of the general fund and property taxes. Nonetheless, you still have to comply with those. So sometimes we would have to secure the debt with income taxes, which is perfectly fine in Ohio. Obviously, that's your main source of revenue anyways, and we really haven't seen any kind of pricing difference. We can switch to a general obligation this year because the triennial property value update by the county, which they went through, I think, Keith, a couple years ago, we now are seeing the effect of that this year. So the entire tax base, basically, for Lakewood has been increased based on the updated property values that the county updated a couple of years ago. This is sort of the first year we're seeing that payment. Go ahead.
In 2017 was the first, in 2016, we did a bond issue and a note issue. And in that year, we refinanced some water and sewer debt and made it general obligation. As a result of that, we came pretty close to our debt limits. We were totally fine. But then when we continued that all as general obligation. So in 2017, we made the decision, let's keep our notes, let's move our notes to this income tax revenue debt, because then that will give us flexibility to keep bonds in general obligation. The pricing differential between notes, general obligation versus income tax was negligible,
Right.
Not very significant.
Right.
But it is more significant when you go to bonds. So we made that decision because that was the only way we could issue the amount of notes for the next year that we wanted to. The difference is between 2017 and 2023 is that the assessed valuation, which is what we look at to see what your debt limit, to see how much debt capacity you have, that's increased 50% between 2017 and 2023. So what that means is you have the flexibility now, and we're still not up against that debt limit. Next year, we could choose to move the notes back to income tax revenue without any issue. But for this year, we've decided to move to general obligation, partially because we can, and partially because we're also doing an official statement, which we'll talk about a little bit as well. And it's just more common to see an official statement with general obligation.
Mr. Chair, I've got a couple of thoughts or questions actually on this very point. Otherwise, I'd hold my questions to the end. So thank you, Catherine and Jeff and the whole finance team. Let me just make sure I've refreshed my memory and ask a clarifying question or two. So if I follow you correctly, the transfer of, well, we retired water and sewer bonds, and question number one is, how far back do those date to? I think it was a while ago,
So I
during a
think
financial belt tightening period.
we did that issue in 2016.
Okay.
And I believe some of that debt, well, and then in 2017, we did another defeasance. And then 2017, I believe that issue went back to 1995.
Yeah,
Now,
that's
it's
my,
hard
so
to
my
tell.
question is not when the debt was transferred around, but when the debt was originated in non-general obligation
So I believe the 2017 debt was originated in 1995.
Okay.
I'm not, I can look that up for you. if you give
Long
me a
ago.
minute. Yes, it's.
Oh,
a
long ago, for sure.
and-
Okay.
And in 2016, I'd have to even look, because 2016 had so many things as part of that issue.
Right.
That the water and sewer debt that was part of that issue may have matured. We just look at the combined issue, so I'd have to look at that, but
See the
yes.
assistant finance director about to fall on his sword and say he remembers that far back. I
If you
hope
give-
not.
If you give me a minute, I can look it up.
Mr. Chairman, just clarifying to Councilman Bullock, in 2006, the city issued water and sewer revenue bonds. Those then were refinanced in 2016, as Catherine is explaining, as general obligation.
Okay.
Just real quick, so you know, part of the reason too at that time was 2006, the market was different then, and there were a lot of requirements, reporting requirements of the city that were costly and incredibly cumbersome and time-consuming. So by switching how we did in 2016, it got rid of a lot of bureaucracy and paperwork for the city that was unnecessary in today's timeframe.
I think I recall that, but here's where I'm really headed is, it'd be helpful as part of this to understand from the biggest macro budgetary perspective. We have needs over here, we have a financial capacity over here, and then we've got the debt in all these generations and series that we have to skillfully manage and shift and so forth. And I have full, faith and confidence in the team in very intelligently taking advantage of market conditions and interest rates to maximize the stewardship and the impact of scarce taxpayer dollars. But with and you already answered one of the questions was, what's the increased valuation of Lakewood real property, and what's the impact on our strategy? And so, Catherine, you already answered. 5 years, it's increased 50%, which is phenomenal. So that means we've got more capacity. Now, I get letters from time to time from the credit card companies that say, guess what? You've been pre-approved to
Right,
spend.
right.
That doesn't mean I should take advantage of that and max out
That's right.
to the hilt.
That's right.
At the same time, we live in an aging community with aging infrastructure, and as the finance department leadership is familiar, the civil engineering side of the room has a lot of projects they like to propose for good reason. But that's my question, is to get some sense of how well our financial capacity, which is now increased, marries up with our financial needs on the capital side.
Right.
And that may be beyond today's discussion, but it would be wonderful to have a pie chart or a graph of some kind to speak to what, Catherine, you just alluded to. All of a sudden, our financial capacity bumped up. What does that do to how much our obligations on our debts and notes and all these financial instruments? How much more room do we have under the cap? And therefore, what do we do with that? Do we not actually obligate all of our theoretical capacity because increased interest costs and also just not putting that much pressure on the taxpayer?
Right.
Westlake pays cash, don't they? Not a very good client, I guess.
For a
to-
lot, yeah, right. For a
We're
lot
not
of, they
Westlake.
do. For a lot of improvements, they do pay cash.
Well, one thing to note is that, in 2006, up until 2016, you had this water and sewer revenue debt, so that didn't count towards this general obligation debt limit. So you were still borrowing, it was just under a different umbrella. Same thing with last year, your income tax revenue note did not go into your general obligation debt umbrella. It was still debt. I mean, effectively, it was the same, it was also debt. You had a revenue source, you made these decisions. We're just now moving umbrellas, but not borrowing, it's not a decision for, we're getting closer to the debt limit, but even if we didn't borrow this as GO, you're still borrowing. Does that make sense?
It does, and it helps. What I am, though, observing is that over the years when I've asked the question, not just to this administration, but to previous, are we on track to meet the city's capital needs? Usually the answer came back, well, we're talking about financial capacity to pay, which is relevant and important and probably the limiting factor. But we never got a full answer to, are we keeping up with our needs? And now I'm flipping that around, which would be, you know, I'd love to get a clearer sense of how much of the community's credit card limit should we ever be entertaining obligating prudently, okay? And so, you know, we could maybe talk offline afterwards in the aftermath of these discussions, but it would be good to get a sense, because that's shifted so much due to the property valuation. So you would think maybe we can breathe easy now, but I don't really know if that's true, because we have significant sewer and water, it's wastewater collection and obligations to meet. So, so as we, you know, kind of do this informed discussion about how we're making decisions around the current debt that we have, the debt we have to retire, pay for, what I'm hoping we can also do is understand what's our plan for the next 5 and 10 years. Because Jeff, you annually do credit the city leaders who years ago created dedicated debt service to pay for this, and that was a wise decision. Do we need to revise that? Are we on track? Is that still serving us well? I don't know the answer to those things,
Yep.
and it would be probably with the expertise of this team here that we'd get our hands around this. Consider this more the annual physical. I don't know that there's anything wrong, but I am curious to deepen my understanding of some of these questions. Sorry for
No,
too
and that
long
makes-
of a question.
Certainly makes a lot of sense. I will just say at a high level, what we tell a lot of municipalities is the debt limit, the statutory legal debt limitations are for general obligation type debt, and there are ways to get around those debt limitations. And when I say that, I don't mean that to be like fraudulent or tricky or anything like that, right? They're just sort of in place as a guide, but they're in place as a guide for scenarios that I would say are unlike Lakewood, right? What we tell municipalities are, it's much more important to look at your capacity to pay as opposed to where your capacity might be against the debt limits, because the debt limits are a point in time, and they're, I guess I would say, somewhat arbitrary, because they're just out there for all Ohio municipalities. And there are ways where you can issue debt that don't, that wouldn't fall under those limitations. So it isn't as much the limitation, I would suggest. It's more, and I just got this question from the city of Canton, actually, just last week, and answered it the same way. We have to work on and identify what can cities afford to pay. In Lakewood's case, that's much more, I guess I'd say, identifiable because of the statutory millage in your water and sewer type funds that we always show the rating agencies, right? Because we're showing the rating agencies, they're not really looking at where you are on the debt limits according to Ohio law. They're looking at where are you going to pay this debt, and where's it coming from, and what's your sort of capacity there. So your question certainly is a great question. I would suggest it ultimately won't be answered by where you lie in relationship to the Ohio debt limit statutes, but more so what's the capacity under these different dedicated funds you have for debt service, because that's really your capacity. And then I think, because we do a lot of work with inner ring type suburbs like Lakewood, it seems, like you said about your infrastructure, it seems like you can never have enough, that you're never going to always be caught up, right? So I think you're always going to have projects that could get done, even if it's more street resurfacing, right? The question is, how do you do your best to keep up within the confines of what you can afford to pay? And that's sort of probably some analysis that we can work with the finance department on to get to the committee in terms of, as you go forward, sort of how do those different funds, look like they will be impacted by both property value increases and other, fees and revenue that goes into those funds. So I know that's not an exact answer, but hopefully suffice for now.
It
But
is
certainly-
helpful, and
certainly,
you-
yeah, we
you-
can certainly get a better answer.
Educated
as
me
we-
that I'm looking at the wrong metric, so
Yeah.
that's a step in the right direction, so
No,
appreciate
great.
it, thanks.
No, it's good, good. So then, continuing on to the next slide on page 9, just showing you the exact breakout so you know what would be financed with this note. The top box shows that there's about 16.4 million in new projects. Those new projects are listed by category below. And if I recall correctly, I think during the budgeting hearings and budgeting sessions that you all had on capital improvements, you may not recall exactly now, but if they were to tell you the projects that are in these categories, they would probably jog your memory to those discussions, because those projects were discussed at that time, and they fall within these various categories. Primarily, Keith, I think there was one really large project, if I recall. And then the other portion of the note, the 21.2 million, is retiring last year's note that's coming due this year. So that's what makes up the balance for the year. So that's the financing. Go ahead.
The
Did you have
oldest
another?
projects
Yep.
in the 2022, in the refunding portion, the oldest projects are from 2020. So the projects that were not yet complete when we did the 2021 bond stayed in notes, and they've just remained in notes since 2021. So it's not that we're holding some projects that are really old into that note.
Those, so those 2020 projects, once we do a bond, they'll be rolled into the bond.
That's right.
Typically, what the city has done in the past has been any projects, we have this long list of projects that are in there. And we note what they are, and then as the projects are completed, any projects that are completed when we go to bond get moved and are bonded out. Any projects that are not sort of completed, in some cases, if it ever happened that you spent less than you planned to on a project, then you wouldn't want to bond out the full amount. You would want to pay it down and keep it in notes until when it was done. Sometimes there are some of these projects that you get grants for, right? That you finish them out, you get a grant for having completed it, then you want to borrow the lesser amount with the grant portion taken out. So there's lots of things that we do, but the next time we go to bonds, we'll take all of these most likely that are done.
So with that, we thought we'd just hit very quickly just some background for you on your credit rating, on the city's credit rating. We've talked a little bit about this, I know, in the past. Slide 11 just shows and sort of gives a history of sort of where the city's ratings have been in the past. There's 3 primary rating agencies, Moody's, S&P, and Fitch. For a city your size, you really only need 1 rating, and you have to pay for these. So it doesn't make sense to pay 3 rating agencies to tell you the same thing. Moody's was chosen long ago, just happened to be. I would suggest one rating agency is not necessarily better than another. I think Moody's is very good when it comes to city government, though. Nonetheless, Moody's has continued to maintain an active rating on the city in the AA2 category. So you can sort of see these are all the listed on the left-hand side, all the investment grade. They'd be considered investment grade ratings. You can see, obviously, you're towards the top of that list. The national median average for U.S. cities is AA3, so you're above that. And I honestly will tell you that that's remarkable because Councilman Bullock, you mentioned about Westlake, right? I mean, Westlake just has I'm not trying to pick on Westlake, they have a gigantic tax base with a lot of industry and a lot of high sort of business taxes, right? Lakewood is much more of a residential community, has what I think is tremendous charm and positive attributes in terms of the diversity of residents, of businesses, a lot of smaller businesses. So your tax base is large in aggregate, but not going to be as large when it comes to sort of identifying debt limitations and such as a city like like Westlake. So, and you sort of look at cities like that as more being out in the green fields and not having to redevelop properties or deal with environmental contamination, right? Or deal with, which I applaud you for, dealing with a host of social issues that you have to deal with, right? As your policymakers in your government, right? All that's to be applauded. Unfortunately, the rating agencies don't always give you dollar for dollar credit for that, right? So, but they do give you some credit, right? Like if we did a strict, I'll just say, if we did a strict scorecard of the strict economic measurements that Moody's does, Lakewood's rating just on the scorecard, because it's so strictly numbers-based, would fall below AA2. But Moody's has made it very clear to all cities that they don't just rate a city just on the numbers. They also look at your institutional presence, how large you are, and sort of how mature you are. And then they also look at the management of the city, and that includes council as well as the mayor's administration. Lakewood's always has scored off the charts in all of that, and has allowed Moody's to very comfortably move you up into this AA2 category. So feel good about that. That's honestly about the entire city and about the entire city leadership, not just one part of it. Also pleased to report that just in December, they reaffirmed the city's rating at AA2. So we don't foresee Moody's reaching out to us to revalue the city until at least next year. They always have the right to, but we wouldn't expect that to occur until next year. So that's some thoughts on the rating side. I won't really get into anything on slide 12 because it's from an old report, the last credit opinion, right? So Moody's will maintain a rating, but they will only periodically draft a report about the city. And so the last one that they actually drafted is now getting pretty old. It's from March of 2021. Here's sort of some of the comments that were made, but we really don't have to spend much time on it now just because it's starting to get old and stale. The general comments, I think, are all still true and the same. Some of the actual numbers in here have probably changed slightly, and we sort of update the scorecard as the year goes on, and obviously make sure that we're in consultation with your finance group to make sure that they're aware. So very solid from a credit rating, and would expect that to continue into the future. And that just leads us to, we do have an appendix of sort of some market slides, but really the last slide that we wanted to touch on was the time frame on slide 13. And we sort of work it backwards. The last sort of circle here in the schedule is closing the notes on March 15th. The reason is because your current notes, they come due the next day. So we have to get it done before March 16th. And then we sort of work backwards from there. So if we're fortunate for council to authorize this and pass this, I believe at the first meeting in February is when it would be on for third reading. That would allow for us to conduct a marketing and a sale of your new debt in February and early March in order to meet this schedule to close. So there's nothing compressed here, like we're not having to hurry or anything like that. We're right on schedule, and I don't know if you wanted to add anything else about the schedule or items I may have skipped over on your part? Okay. So with that, happy to answer any questions, of course, unless the director or assistant director have any comments or additions? All right.
Thank you, both Catherine and Jeff, for coming out again. Nice to see you.
Yep. Thank you.
So what are we looking at in terms of rates? I mean, I do see
Yeah.
that maybe this is something we'll get to later, or maybe this is something that comes once you issue the notice of the debt and do the whole rigmarole of selling it and all that jazz. But I'm sure we can have you have a general sense for a bandwidth, the principal's 37.
Yep.
37 and a half, 38, somewhere around there. What are we looking at in terms of interest over that, next year?
Yeah, I will answer specifically. I'll also point you to slide 16, just to give you a very quick background. These short-term notes are priced off of what's called a MIG-1 note scale. And so the MIG 1 note scale basically is, at any point in time, it's sort of taking the largest and highest rated governments out there, which would be state governments, right? So we're talking huge governments. And again, Moody's looks at it more from a number standpoint, so they're going to look at states that have lower tax burdens, that would be mainly like in the South. They're going to assign ratings, and pricing will occur off of that. And that establishes the MIG 1 note scale. And then a lot of municipalities that borrow, like we're talking about here, will price at a spread to whatever the MIG 1 note scale is, right? Unfortunately, you can see we've been at really low rates, and then obviously in 2020, that was with the pandemic. We spiked up for a short while, came right back down, and now with inflation, even governmental borrowing rates are obviously higher than normal. I could tell you we're probably, and this is just tracking the market, right? This isn't really a Lakewood. Your credit profile will sort of remain at a similar spread to MMD or to MIG 1 scale than you have in the past. So it won't be your credit, it's just the underlying sort of MIG 1 scale that's going to drive your pricing up. So by way of comparison, and I know this will be somewhat painful, but the hope is that the funds that you have on hand at the city that you're investing, you should be getting a higher return, right, than you got over the last several years as well. So hopefully you're getting some benefit on the investment side. But on the borrowing side, last year we borrowed, just in case you see it, so it's not confusing, the coupon rate, the interest rate was a 175, but the yield is the true number. So when you ask, what did we borrow at, it was a 108, because investors basically paid more money to buy up the interest rate, right? It's sort of the opposite of, like, if you pay points on a mortgage to buy your house, you can buy down your interest rate. Investors sometimes will like to pay up to get the interest rate, the stated interest rate on their debt higher in case they need to sell it or trade out of it later. It's more attractive.
So I understand that 1.08% represents the true cost.
That's right.
Exactly what we paid
Yes.
as a percentage of the interest.
Yep, that's exactly right, right. And the number this year that we would expect is about 200 basis points higher than that. So we'd probably be like about 308, 310 in that range. And that's just a function of just where the market has gone with the Fed increasing rates, over the last probably, 9 months now.
Mr. Chair, follow on to Councilman Rader's line of questioning. So, finance team, does that mean because we're now paying triple for interest, that's reflected in the principal that if the principal's the right term, the total amount of debt that we issue and then finance over time, that the higher cost of financing over that extended period is going to come from somewhere, right? The answer is ultimately the taxpayers. So are we then calculating that in? So whereas a couple of years ago in the lower interest rate environment, we would have been able to issue this much debt, now we're down a little bit, a couple of rungs on the ladder. Is that how it works, or no?
I would say that having higher interest rates definitely limits our capacity a little bit because they're higher and we have to pay for interest instead of projects. So really historically, I mean, you kind of see what's happened here since maybe was this 2004 to 2022. If you were to look back, a few more years, the rates were higher than this. These aren't like really bad rates historically, but historically over the last few years, yeah, they're higher than what we saw. I mean, last year we paid very little compared to the rates that we'll experience in 2023.
Okay, so can you help us characterize that? So since we're paying now, we contemplate paying about 3%, a little more than 3% in interest. How much does that then reduce our capital debt compared to what it might have been? Issuance, I should say, the issuance for the given year that we're talking about. So it would actually we're issuing new notes, I think, is what we would say. And how much smaller would that new note issuance be compared to if if we weren't in a higher interest rate environment? Are we talking about a whole bunch or just a little bit?
Just order of magnitude, I can tell
Yeah.
you, you'd be talking about, like in the hundreds of thousands, not in the millions.
Okay.
So you're probably talking.
A small side.
$300,000 to $400,000, right?
A small-
Which to all of us is still a lot of
Yeah.
money, right? But that's not like a street, right? It's $300,000 to $400,000,
A
not
couple of parking lots or maybe a short resurfacing.
maybe a short resurfacing.
Yeah. Okay,
Right.
good. That answers what I was asking. Thank you.
I will note that I just pulled back. We have sort of, some plans for what we're going to be borrowing in the future. So back last year, we had some plans for the new money that we were going to borrow this year, and that amount was $23,359,000. That's just the new money portion. And ultimately, the new money portion is about $16 million. So
Okay.
that change happened in this budgeting process. I'm sure there were many factors as part of that, but there were projects that got moved around. There were that probably came into this discussion.
Some of that ARPA fund.
You may have gotten grants.
Similar one-time
I would
grants,
expect,
okay.
right, a lot of times you'll have projects that you might be applying for grants, so you're going to have other funds that have funded those. Yeah, I would, and I know Catherine's not suggesting this. That certainly, that big drop in that number doesn't reflect.
Doesn't
the
mean
interest
$7 million
No,
in work
but
is
there
not getting
were-
done,
Sure.
but
there were-
we found it.
The plans changed from year to year, is just what I'm showing.
Right.
Right. Yep,
Okay, thank you.
sure.
I have one comment. I'm sorry. Addressing something you said at the very beginning, you commented on 6 ordinances. I just wanted to clarify that the first ordinance, the parking meter ordinance, that isn't the financing. So we have 5 ordinances, and then there's an additional, that was at the December 19th meeting, for first reading. You're welcome.
Okay.
Yeah.
So, let's talk about the, These really are the projects that were in those categories, but a little more delineated out, right?
Correct.
Okay. Are there any questions about any of these in particular? Anybody have? We talked about these projects during the Finance Committee hearings last year. I have to double check something. Please bear with me one moment. Go ahead, Tristan.
I was going to ask a question. Just going back to the interest rates, just to like put a finer point on it, I guess. Because I do see there is like a range represented in this last page, page 16.08 to 3.76. Years past, it's been pretty dead on. Whatever you said is what it is. Now that's a little bit more volatile, I guess. Is there a plus or minus? Is that growing? Is the over/under becoming a little bit more? Just curious what kind of volatility, what the volatility is doing to these decisions, and how you're proceeding with selling this debt.
Yeah, no, great question. I think the good news is we've actually started to see maybe I was going to see if it was reflected yet in the graph. We've actually seen rates start to come down now a little bit as a function of a lot of stuff that's happening in the market. I would have said maybe 3 months ago, we probably would have had to put a little broader range on it. I think over the last month and really over the last couple of weeks, it's really settled into a spot of where I think we can very confidently say we would price somewhere between a 305 and a 315 today, right? Within that 10 basis point swing. I don't, and that's not to say that the macro market is certainly volatile with everything going on, including everything that's happening in Ukraine and with inflation, right? All of that is sort of, makes you rightfully so think the market is pretty volatile. When we boil it down, though, to sort of where we are for city government type debt, we can pretty much, make it a much more narrow window. Even during these times, last thing I'll say is one of the things we really watch in our market is the amount of money that goes into bond funds, right? So every single week, there is data that comes out in terms of whether there are inflows into municipal bond funds or outflows, right? Are people pulling their money out and investing it somewhere else? Or are they putting money into municipal bonds? We obviously hope that people are putting money into municipal bonds, because the more demand there is from those types of investors, the better the interest rates we can get for you, because there's just more cash out there to invest. For the longest time, I shouldn't say the longest time, for the time that the chart on page 16 shows rates going up, funds were being drawn out for about the last year. Over the last 2 weeks, we've had some major inflows where funds are now getting pumped back into those bond funds, which gives us even more confidence to sort of pinpoint that rate for you. Thank you.
Mr. Chair. Can you explain why that is? What's the market logic? Why?
Yeah, I could,
in?
yes, I can. Honestly, I will say, and I'll preface it with, sometimes the market does things that they're not in this case, but sometimes they do things that are irrational, absolutely irrational, and make absolutely no sense. But I guess it is what it is. But in this instance, I think there is a clear sort of sentiment of, while inflation is still high, it's starting to come down, and people have seen that in the statistics that have been coming out on inflation. So people are starting to feel like there's some control over inflation, even though it still has to come down more. And I think a lot of folks are also looking at data that says, that the economy is slowing down as well, right? And so in times of when the economy typically will slow down, the typical response from the market is to put money into government-type debt because it's the safest, right? So, or in very volatile type markets, you typically, but we didn't see this over the last year as much, money coming into the government market, which to us was strange. I think that was more a function of the inflationary sort of data taking the day or ruling the day. Now that inflation is sort of, and I'm not by any means suggesting we're done with inflation, right? But it seems to be coming under some control, and the supply chain seems to be getting better. Certainly not at all where we all want it to be, but it seems to be getting better. It seems then now that the market has focused more on, all right, what about the overall economy? And while the economy is not bad, it's certainly slowing down, and that's, I think, the major cause for investors to say we want to, start parking our money in safe government type investments, which we need that to continue, and that'll keep driving down rates on your end as well.
Thanks.
All right. Thank you for answering questions, our questions, the presentation. I think we're going to vote all this at once in a minute, but I apologize to the planning department over here. I should have just had them go first, but this probably was fascinating for them. Yeah, that's good. Less distractions. So we have this other ordinance. Well, thank you. You could go if you want. but
we're good?
Yeah,
We're
yeah,
done?
you're good.
Okay.
Thank you. Appreciate
Sure.
it.
Thanks all. Thank
Anything
you.
quick, real quick? No? Okay, you're good. All right. So,
Mr. Chair, they may feel a little on firmer ground if we considered votes on the ordinances that they were here to speak to. Do you want to dispose of those?
I mean, I think I'm just going to go with this and get this all done real quick. All right, so thank you. We have we're talking about some amendments to the parking meter fund, section 129.16 under the codified ordinances. I'm sure Dave has a very robust presentation, PowerPoint prepared, but you want to if anybody just wants to go ahead and introduce this, and we can dispose of this rational piece of legislation, that makes a lot of sense to me. So go ahead.
So ordinance 49, 2022 was put together with a collaborative effort with planning, law, finance. It's really meant to better define a lot of the different functions that we'll have using public spaces within the city of Lakewood. So traditionally, that's been traditional parking, but now we're starting to park other things and have things like EV chargers, and we have the scooter pilot. So what we're doing is we want to put those funds into the parking fund, where we can kind of keep a closer eye on them, as opposed to where it might get lost in the general fund. And then when we want to reinvest in those type of things, we'll be able to see exactly where we're at in terms of that. If there's anything I need to point out specifically with this, it's really just that we want to be able to track the revenue coming in and the revenue going out in one place without having to take it out of the general fund. So we have it right here in the parking fund.
All right. Well, that makes sense. So these are like charges for charging your car, or revenue from that we get from the scooter companies will now go into the parking
Yes.
fund. I also see that is it repealing section C, D, and E also, because they're not restated?
So that goes back to, Mr. Chairman, like how the tax budget is comprised, and they're kind of old rules and outdated, and we kind of talked it over with ourselves with law. We also talked with the state auditor state when we did this also, and it was just best to remove those things because it's just kind of antiquated. It's not things we really use right now.
All right. I guess I'll ask Councilman Bullock is the Dean of Council currently. Did you ever receive a annual report about parking meter operations?
No, I don't recall that. Thanks, Mr. Chair. Although I'd be happy to give the dean word to another council.
Yeah.
So I don't recall receiving. I think that what I can recall regarding parking meter operations and planning has all been under a public safety annual report.
Yeah, well, I guess it goes to show you they're antiquated little subsections. Any questions?
When you want to ask about microfiche and smoke signals, call on me again, and I'll
All right.
see what I
Any
can.
movies from the early 80s? Or? Okay. Well, I'll go with the committee first, and I'll go. So, Ms. Capel.
I just had this all seems clear and just simplifying essentially, and makes sense, a lot of sense. I just had a quick question regarding if these funds could be used for bike racks, those sorts of things. It seems to me that alternative forms of transportation is a fairly broad, that's in the end of section B. So if it has something to do with transportation, these funds would be applicable. Is that an accurate reading?
It would be something we definitely want to look at, so we could put it, into this category, certainly. Any kind of public space, really we're trying to get the EV chargers in here. Two, scooter thing came up, or if there's other things that we think we can put in there, yes, that's kind of the thought and idea with that specific verbiage.
That was it.
Thank you, Mr. Chair. And my question is more so related to, I guess, how much money is in this fund? And I don't know the exact amount, but I know it went down year over year, so I'm just curious as to operationally the reason for that and if it's been addressed.
Mr. Chairman, we have to get back with you on exactly, what the numbers went down to. We track it kind of every month. It would be in the December report. I know I track it really every month. I kind of compare it to last year's and the year before. I know, for instance, this year we had about 16,000 that came in from the EV chargers and about 1,000 from the scooter revenue. Scooter revenue is not ever going to be a big money item, but we do hope to kind of prop the fund up a bit with the EV charging and just having a place where we know we can reinvest in EV charging going forward. This also has parking. I think you had asked a question a couple months back, just privately in an email, and we responded back. It had to do with the revenue from police citations, and I think we kind of answered that at that point as to kind of what was going on with the different, the parklets and how that was kind of affecting revenue to some degree. And that, again, is kind of a reason why we wanted to have a place to have all these types of activities in one place.
And thank you, Mr. Chair. Just asking if I think that, if I remember, the response was somewhat related to a parking enforcement position that was unfilled, and that was, obviously, if there's no one in the position, you can't issue citations, and citations are a primary driver of the fund, but also it turns over spots, which is the primary purpose of having meters. So I was just curious if anyone here knew if that position had been filled.
It hasn't been filled yet, but I know that it was being recruited for.
So there's intentions to fill it?
Yeah, it was definitely on the website. I did see it there.
I believe they're actually down 2 positions currently. There's only one parking enforcement officer at this point in time.
Thank you. Yeah, and I would just encourage, I'm sure the administration is doing their best to hire all the open positions, but, that the whole point of the meters, it's somewhat revenue generation, but it's also burn and churn. And if people know they're not getting, if you live in an apartment next to a meter and you're not going to get a ticket, then you just leave it there. So that's my only point. Thank you, Mr. Chair.
Mr. Chair?
Yeah.
Okay, to follow up on this line of questioning, so I'm not clear from the wording. So when somebody gets a parking ticket, do those revenues go in this fund or a different fund currently? So the way I read this, the parking meter fund would be when I put quarters in or I pay the app, it would go into this fund, both the existing and the future proposed version of it. And then we're also proposing to add revenues from the new use categories. But when somebody gets a citation issued, that's parking enforcement, is that a different revenue stream that goes to a different spot?
Actually, yes, that goes into the general fund.
Okay. Okay. And then we fund the parking enforcement personnel costs, salaries, et cetera, from the general fund also, correct? Or no?
They're funded out of the parking fund.
Okay. So the salaries for the enforcement officers we were just talking about get paid for only out of the parking fund?
Correct.
Okay, and then I've got to think that a citation generates more revenue than our pretty affordable, modest, quarter for 15 minutes, or less than that. It's a quarter for 25 cents gets me 30 minutes at most meters in Lakewood, right? So the citation, which could be $25 or higher, although a third-party firm gets a chunk of that, that's not going to replenish the salary of the officer writing that citation.
Correct.
Okay. So that, Councilman Baker, may be part of why the fund is being diminished, because it sounds like we should restructure that. Don't you agree, Director Rekator?
Not necessarily. So what we have here is the funds come into this fund when we're talking about like metered revenue. So if I'm looking at the sheet here, I'm seeing all the different meters throughout Lakewood and, you know, the revenues from each place, you know, people that are paying for parking permits. That's the activity that goes on specifically within this fund as opposed to, you know, getting a ticket and that fine going into the general fund.
Okay. Let me switch gears to the EV stations and electric scooters. Perhaps we should make an amendment here under paragraph B to say not just and electric scooters, but electric scooters, comma, bicycles, comma, and similar devices. Assistant Director Boss, are we about to get electric bicycles at some point? And, you know, before the meeting ends, I'd love to hear if there's do we have clarity on our plans for the pilot project? Will they, should we reword this to say, and electric mobility devices?
Yeah, Councilman, you could reword it. It's just regards to the pilot. I mean, we're kind of on hold until the survey results are received, and then I can kind of mesh that with the usage data and provide that to the mayor for review.
Okay. And please also provide it to City Council too.
We'll
Thank
do,
you.
yes.
Because, you know, I think many of us are keenly interested in this, and also, you know, users and, you know, we interact with the intersections where these are located. Go ahead.
Just to your point about will we receive bicycles, that's something we had conversations with the vendors. Unfortunately, a number of them are not offering bicycles. From a business plan, the scooters are easier to manage operationally, and also they're much more desirable from a marketplace. So we're still hopeful to get bicycles.
Right,
but
right.
we
So
don't-
for now, we're not into bicycles. I saw one at Cleveland State University campus just
Yeah,
the
they're coming
other
across
day.
from Cleveland, the bikes are.
And so, okay, so Mr. Chair, I would be happy to support a motion to amend the language to broaden it at the appropriate time. But, okay, so the Director Rekator, and I guess I'd welcome a dialogue between the two departments here. When we agreed, when City Council, it was a thoughtful proposal from the Planning Department of City Council, and I certainly agreed to it based on the logic laid out for charging electric vehicle charging rates and fees. What we agreed to was a pretty affordable rate, more expensive than the free couple of years or 3 years that we had, but an affordable rate that was keyed to a 10-year replacement cycle so that the equipment would kind of self-replenish. So we'd be able to pay a 5-year extended warranty beyond the initial 5 years, and then at the end of 10 years, we'd have accrued enough funds per vehicle charging station on average that we could replace it. So I want to make sure that we're not taking those electric vehicle charging revenues and then using them to pay for other needs, however legitimate those are, and then when it comes time to replace the EV chargers, the cupboard is bare. So have we had that discussion at all? What's our plan when it comes to that? Or is it the Finance Department's view that we're looking to relieve the pressure for up to 3 full-time positions on the general fund by having these revenue sources?
I think the administration's dedicated to EV charging, and that's something that, you know, we doubled that in the last budget. We have that planned out for the next couple of years, and that's the priority. To your point about, you know, bicycles, I think Councilwoman Keppel had brought up a good point and asked under 129.16 be kind of the very last paraphrase there in alternative forms of transportation. I think that would probably include, you know, what you had alluded to earlier. So I just kind of wanted to circle back on that point.
Thanks.
Also.
I mean, Planning Department, do you care to comment on what I just raised? as far as, in other words, the stated intention, and I think it's a good one, is to practice foresight to be able to have a revenue stream to replace, and we keyed it at a level that won't overcharge users and patrons, right?
Councilman, yeah, that's exactly the way that we approached it. I think, and we're approaching that 1 year point here, the beginning of March, and so probably in the coming month, I'd anticipate doing a review of that revenue that was generated over the last year based on that specific rate that the 24 cents per kilowatt hour, from what I remember, and kind of take another look at that 10-year time frame, kind of where the account is, where should it be, and I would just preface that that review may come out with, the math may come out with, well, you need to jack the rate up to 40 cents a kilowatt hour or whatever. That's got to be a conscious kind of decision in terms of competitive rates, and another kind of look at of what rates are in the region, so that we don't outprice ourselves, but we also, appropriately have money in this account to pay for things like warranty, renews, and to contribute towards the purchase of replacement equipment when that comes up on that schedule.
To contribute to, but not fully cover
And
necessarily?
that's what I would say, that's the difference that may be just based on the realities of what everyone else is charging versus what, like a model over that 10 years that I showed you last year, it may tell us that based on the revenue that we collected, that you really, you need to triple your rate to make up the amount to pay for all that equipment. And so that may not be realistic.
Okay, so I look forward to your report in, a month to 2 months. That's a good topic. But I guess what I was driving at is you're trying to get a read on how much revenue should be collected, but at the same time, we're not putting those revenues in escrow, according to the finance department. We're putting in a pool of funds that is paying salaries.
Yeah, I can't really speak to the
So,
accounts and the use.
I think we've got a difference of view that we should get clarity on.
It's going into the fund, and sorry to interrupt.
Go
It's
ahead.
going into that fund, but we can track we can track the information that's flowing into that fund to understand. So the parking fund comprises the fee generation from the use of the parking meters, permits. We can track the generation of funds that went into it from the scooter share that we get for each ride. And then we can also do the same thing from the EV charging point. So yes, it's going into that fund, but we can see the dollars and cents that went into that to support that fund.
So is there something in place currently where y'all are saying, like, these are all going to the parking fund, or will all be going to the parking fund, but we know this is the amount that is dedicated in that parking fund for the EV charging stations? Or is it all going to get all mushed together and we're going to be like, well, we need to pay these people now. Hopefully the EV charging stations go and revenue goes up and we'll be able to afford it in 10 years.
Mr.
Yes.
Chairman,
Yeah.
we have tracked and for December for 2022. So the revenues that the city received were approximately 15,000 last year. Our expenditures for the electricity for that was about 8,400. So we had net revenues of $6,700 in 2022. So we're tracking that every month. David sends me a report every month from ChargePoint, so we have that information, and we're making appropriate journal entries into the system. So as Director Rankator discussed, everything's in place for that.
Right.
So we are having that track. So right now, whether 6,000 is good enough for in the first 9 months, we don't know. And I think as,
Right, so y'all's eye is on it, that, heck, it's not going to get lost in one fund and being used for a whole bunch of other purposes, and when it comes time to replace the EVs, we're like, oh, wait, we don't have the money that was supposed to be set aside for the EV charger replacement is spent elsewhere.
Yeah, yes, that's correct.
Okay.
So from an administrative standpoint, now we're better able to track these revenues that we're getting from EV charging scooters, because we're putting it in that fund. It's not getting lost in a miscellaneous revenue category inside the general fund, or, you know, or charges for services just somewhere inside the general fund. It's specifically indicated out inside the parking fund.
So it's delineated within the parking fund?
It-
In a way-
We have an account.
An account
Line
in,
item
you have
for
account
that.
line item in the parking fund?
Right, so
that-
that's why I can see, okay, here's $15,257. I can see
Okay.
that on paper now because we're tracking it. Before, I wouldn't have been able to really know that unless I, you know, went back and started putting all the pieces of the puzzle together. And that's kind of what this legislation helps us do, is just be able to better track that within the fund. So all the funds cover, you know, a bunch of different things, and, you know, it's at least better delineated inside parking fund than it would be inside the general fund where it was housed before.
All right. Tristan, kind of, unless Tom has a, okay, that answers it?
I want to acknowledge, thank you, Director Rankator. And so in other words, the spirit of this proposal is to take a step in the direction that I was advocating for, so appreciate the explanation.
No, and thank you, Mr. Chair. And I'll just echo what the chair and Mr. Rankator just said, and Tom, like, this makes perfect sense. Thank you for your due diligence and keeping track of this. I just wanted to add my voice to this, and I think Tom was getting to this point too. Like, even though we're tracking this, it's important. I don't think the point was ever or is ever to make sure that we have enough in this account to cover expansion of our EV network or total replacement costs. It's just a supplement, right? I mean, that's just my sense of one of, not on the committee, one of 7 here, but I think that resonates with the public here. We want to make sure we expand this, and it's great that we're thinking ahead and we're helping supplement that, but we need to put a lot more resources towards supporting this and growing this network, and this is great work towards that end, so thank you.
All right. Well, looking at this, I think it might be prudent for amendment to, so this is what I'm going to do. I'm going to move to amend this ordinance for on 129.16 parking fund, section B, used for, of revenue use. After, I would cross out the period. So in the first sentence, I'm crossing out the last "and" before electric scooters. I'm crossing out the period. I'm putting a comma there. I'm replacing it. And I'm putting "and alternative forms of transportations" to it. So it matches the end portion.
Second.
All right. Discussion? Is that a problem?
I was going to suggest the term mobility device, because that's the term that's used in the code when we talk about e-scooters, e-bikes, and other, but I
Yeah,
guess
so
I'll
that makes
look to
sense.
alternative.
But I'm matching in, so if you look at the last sentence of E, or the last,
From the bottom, I see what you're
from the,
talking
it
about.
says,
That's
and
fine.
pay the cost when authorized of developing a public space related to enhancement, EV stations, parking meters, electric scooters, and alternative form of transportation. You know,
I think there's a distinction between what you're charging for,
yeah,
what you can derive revenue from, what you could spend on.
right.
So I think you're going to derive revenue from mobility devices, which I agree with Director Leininger is the more apt description of it within popular nomenclature about these devices.
Well, then can we just replace electric scooters with
Yeah, I think
friendly amendment, go and
yeah, what would be alternate mobility device or
you call it?
Just
motorized or
We just call it mobility devices in the code.
mobility devices, yeah, I think you.
All right. So, for the minutes, for prosperity's sake, the motion is,
The hot seat, Henning.
yeah, there was a friendly amendment to that, which was to strike most of what I said and keep the period, but just replace electric scooters in the first sentence of section B with mobility devices.
Second.
Yeah, right. Second, okay. Further discussion on
Mr.
that?
Chair, do we need the word electric?
I don't think, yeah.
Flat, plain old mobility, okay, thank you.
Yeah,
Okay.
all right. Okay, I'm closing discussion. All right, all those in favor?
Aye.
All right, aye, okay. Now, Jesus, how do I do this now? Okay, amended, blah, blah, blah. Yeah, either remove or amended. Okay, got it. I'm going to move to refer to full council amended ordinance 49.
You move to recommend to the full council for adoption the amended version of.
Yeah, what, that.
um,
Make it sound like I said it in the minutes. Yeah,
Second.
all right. All those, discussion, okay, closed. All those in favor?
Aye.
Aye, all right. Now, how about I move to recommend for adoption to full council ordinance 50-2022?
Second.
All right, all those in favor?
Aye.
All right. That passes. Ordinance 51-2022, I move for that to be, God, I wish we had.
Referred favorably.
Referred favorably to full council for adoption.
Second.
Second, discussion, no, all those in favor?
Aye.
All right, that passes. Move to refer ordinance 52-22.
Favorably out of committee.
Favorably to full, for adoption, to full council.
Second.
All right, discussion, all those in favor?
Aye.
Okay, that passes. Ordinance, okay, I'm going to move, recommend to full council adoption of ordinance 53-2022.
Second.
All right, I think that still works, a different way of saying it.
Yes.
Discussion, all those in favor?
Aye.
Okay, now I will move to refer ordinance 54-2022 to full council for adoption, as recommended for adoption, is our note for it. Do I have a second?
Second.
All right, any discussion? All those in favor?
Aye.
Aye. Okay, thank you for bearing with me. Everybody could go home. I'm closing this meeting, adjourned. Get out of here.